Hey, Happy New Year, investors. Welcome to the 40 Finance channel. My name's Jeff Beers. Today I'm going to do my final look back on 2020. I'm going to give myself a grade card here for my investing performance over the past year. We'll take a look at my retail stock portfolio returns and compare that against some of the more popular ETFs and stocks. Reminder as always that my stock picks and projections are just my opinion for your entertainment. Please make sure you do your own research and due diligence before investing. And if you like stock market analysis and personal finance videos, then please make sure you give this video a like and subscribe to the 40 Finance channel. Thank you to everyone who supported the channel in 2020. Very excited for what I have planned for 2021. All right, guys, let's just jump right in. This is my retail account performance. These are all individual stocks. I host this account at Ally, and it's about 2 years old or so since I started focusing on it. Started 2020 with a balance of 21,667. I made $37,000 or so in deposits. I got a small amount of dividends and a handful of rebates, which is just Ally. I loan my shares out to short sellers and stuff, so I make a couple bucks off that. That brought the subtotal of inflows, if you will, to 58,747. The balance at the end of the year was 82,195. That is a net gain of $23,447 and a percentage gain of plus 39%. All right, so plus 39%. I'm pretty happy with that. Of course, we all know that there was a lot of different layers to the stock market this year. There was a lot of traditional companies that were down significantly. A lot of growth companies that went, to the moon and back several times. Generally speaking, a 39% gain is going to be very solid, but this was not an average year. So we're going to take a look at some of the more popular ETFs and individual stock names to see how 39% stacks up against them. All right, first on the board is VOO, the Vanguard S&P ETF. That finished the year at 17.58%. And as most of you know, I sort of poo-poo the idea, if you will, of the top 500 stocks. I personally think it's too many, but that's just my opinion, of course. So thank goodness I at least beat the S&P 500 at 17.58%. I would say if you're investing in individual stocks, the S&P 500 is sort of the line, right? If you go back, I think Warren Buffett did some bet a few years ago with hedge fund managers that they couldn't beat the S&P 500, and I think it paid off for him. But, this is like the core goal for most individual stock pickers like myself. But again, this isn't a normal year. So let's see how some other ETFs did. All right, another popular ETF here, VTI, which is Total Stock Market Index Fund. That finished the year similar to S&P, 20.37%. With this one, you have a huge conglomerate of stocks. I don't think that that's the best way to approach things, but it is a safe way to simply bet on the fact that the market and inflation and all those things go up over time. It's a theory that's been tested, proven year after year. It's just that the returns are always going to be muted some because you have a large portion of stocks dragging down your average. But on the bright side, you've basically got every stock, right? So there's no fears about missing out on Tesla and stuff like that. That are getting plus 100% gains. They're always going to be in the total stock market. So it's definitely a hands-off way to play it. All right, next on the board is one of my favorites, Invesco QQQ Trust. This is the top 100 listings on the NASDAQ based on market cap. Year-to-date return on this one is 48%. So right here, I took the L, right, to the QQQ. I finished the year a little bit under 40%, QQQ, 48%. This one stings a little bit more for me from a performance evaluation, only because I'm a huge fan of the QQQ, and I would have been super happy to beat it out even by a 0.5% or so. But it did not turn out that way. All right, now let's look at ARK Innovation, ARKK, a whopping plus 157% on ARK. Congratulations to that team. They certainly blew me away in terms of performance. And you know, they get a lot of press for Tesla, and I'm sure that played a big part in plus 157%. But kudos to ARK because it wasn't all Tesla. I mean, they nailed name after name after name, and this particular year was just the perfect climate for them, and they executed, right? They made the proper buys and sells all the way up, so they smoked me. You would have been much better off investing in ARK than you would have invested in the stocks that I chose for 2020. All right, now getting into a couple individual names. Microsoft finished the year. This isn't a math equation. I use this as an arrow. They start at 159.53, finished at 222.42. That is a gain of 39.4%. I was at 39.9%, and so I beat Microsoft by a hair this year. I beat the performance of Microsoft by a hair, so I'll take that as a feather in my cap. Great year, though, for Microsoft shareholders, 159 to 222 on a stock as big as this. $1.682 trillion market cap, absolutely incredible. Great year for Microsoft. All right, let's take a look at Amazon. If you only held Amazon stock as your single holding, you would have went from 1874 up to 3256. That would have been a 73% gain for Amazon stock in 2020. Phenomenal year. And interestingly enough, as I went through a couple research items here at the end of the year, and seeing as the stimulus checks are coming out, I went ahead and bought a single share of Amazon. I'll probably end up with 2 or 3 total shares in 2021. But this is a great performance. It doesn't mean that they're going to do this again next year. But what I've mentioned to everybody is this EPS number for Amazon is just almost doubling every couple years. And that's a heck of a feat when your EPS is coming in at 34.20. So take a look at Amazon, do your research. I don't think they're done yet by any stretch of the imagination. We know that PEs are running high in the market in general, but they are going to bring that EPS number up significantly, at least from a projection standpoint, over the next 2 years. And anytime you're riding EPS, you're in a pretty safe zone to take advantage of every market opportunity. All right, and last one of the day, the big dog, the big winner of 2020, Tesla, smoked me as a Tesla bear, if you will. But this is the scoreboard, right? 727%. If you would have only purchased Tesla stock and bet against the stocks that I own in my retail account, you would have, roughly, I don't even know, 10, 15x the percentage gain that I had, something like that. So congratulations to Tesla shareholders. I couldn't be more surprised by this one, but those that held true and stuck with it from the beginning at 85.26. This is split adjusted, always on Yahoo. So you went from 85.26 to 705. EPS finishes at 52 cents right now for the last 12 months. Their EPS is going up as well. I don't think it's going up at the same pace that this price insinuates. However, it's a scoreboard. That's what the price is on the board. So congrats to everyone on Tesla. I was certainly wrong on that one. All right, so here's my report card, 2020 report card. I've given myself a B-. I beat last year's deposits, which is huge. So the amount that I invested in the market this year was more than the amount I invested the year before. That is a key goal for me. As someone who has a family to take care of, I need to keep depositing and make solid bets so that I can leave my family in a better place than they were the year before. I beat the S&P 500, so very happy with that. That would be a midline goal of mine. I feel like I did a good job of managing risk reward. Some people might laugh at that because of me not having Tesla, but Tesla was not a risk-free investment by any stretch. Kudos to those who saw through it, but it did have risks associated with it that I was not willing to take. All right, next up, adjusted strategies. I really came to grips with some of my mistakes in and around October, in and around the election, somewhere in there. So I am pretty critical of myself in the sense, like, I don't lie and pretend that I did everything awesome. So I feel good about my strategies for 2021. I'll kind of outline those in another video. I put late because I didn't adjust in the middle of the pandemic prices, right? It took me a while to stare at this and say, here's what you missed. And I'm okay with that. As long as we are all getting better in everything we do, we are making progress. And the minuses. So I ignored plenty of profitable names. Tesla, just barely profitable. Square turned profitable this year. I did decide to get into them at the last minute this year, but certainly after they had massive returns. Zoom is a profitable company, turned profitable this year, I believe. I don't care about the stocks that are not profitable companies. So if you don't generate an EPS or have some sort of identifiable PE ratio, those are not misses for me. But the ones that do, and these three I think are the big ones, those should be showing up on my radar, and I can't afford to cast away big opportunities like that. So that's a miss, and that's a big reason why I certainly didn't get an A on my grade card this year. Another minus here, too contrarian pessimistic. I have to be careful with this because I think it's good to analyze companies and not believe everything you read, but I have to be more open to wild growth cases. The world is changing, certainly changed this year. And for me to sort of have a contrarian pessimistic view on some of the high flyers ended up being costly. So I have to check myself on some of that behavior, and I certainly plan to do that going forward. And lastly, costly hesitations on price. I do find myself waiting for the dip a lot, particularly in 2020. 2020 did not have a ton of dips. It did not have a lot of red days, quite frankly. And so that cost me some weeks and some gains, and the inability to jump into a few things that I may have jumped into simply because they never paused or went down. So hesitation, if I have my conviction, I need to at least jump in on a small percentage buy for some of these names that show up on my research. I will do a better job of that. That probably would have added another 10 or 15% to my gains for the year. All right, guys, so that's my 2020 investing grade card for myself. I'm saying B minus. Let me know what you guys think in the comments. Keep in mind that the money that I invest is not really for me. It is for my children. It is for the next family iteration of my world. So I don't really look at it like I'm saving for $1 million houses or Lambos or anything like that. I'm trying to take investments that I believe will pay off with as little risk as possible. I don't mind some risk, right? But it's not going to be very smart for me to look anyone in the eye in the future and say I lost 20, 30, 40, 50 grand because I just thought that this stock with very little history was going to go to the moon. So my game might be different than some of the other people you see on YouTube, and we're all at different stages in life, and we're all have a different perspective on what their investments mean to them and what the gains mean to them. And that's what's awesome about investing. You get dividend channels, right? You get growth stock channels, you get penny stock channels, day traders. There's so many different ways to do it. And in my world, I'm a long-term almost value investor. I don't really see myself as a crazy value investor. I am looking for stocks that have a tendency to bounce back, but I also incorporate growth rate into a lot that I do, and I'm doing much more of that going forward. All right, investors, I hope you enjoyed this video. Please give me a like and subscribe. If you did, it makes a big difference, and we'll see you on the next video.